Welcome everybody to this tax time tune-up webinar. Hopefully I don't have to say that too many times, a bit of a mouthful, but we would like to welcome you here today to discuss taxes. Not everyone's favorite topic, but we'll do our best to make it fun for you today. Before I dive into the content, I want to give you a quick introduction to who we are. So our firm is PWL Capital. We are an independent Canadian financial planning and wealth management firm. Our office is based in Ottawa. We work with clients across the country. So we have clients in all the provinces, but only one out of the 3 territories. So if anyone here is from Nunavut, maybe give me a heads up and say why we aren't working together. We haven't managed to break into that space quite yet. So like I said, we do financial planning, wealth management for people. But on top of that, we try to provide great free educational content to people as well. So that includes some technical content like what we're going over today, taxes. We have a podcast, the Rational Reminder podcast, a YouTube channel called Common Sense Investing. And if you go to our website, we have lots of white papers, blog posts, everything, dollars and cents, financial planning, RRSPs, TFSAs, all that great stuff. But on top of that, we're also trying to figure out what happens at the intersection of money and happiness. So a lot of our content actually is about not only how do you accumulate money in your accounts, but how do you use that money to live a fulfilled life and make a difference in the lives of people that you care about? So if you're interested in any of that, I encourage you to check out our content as well as future webinars that we host. My name is Jordan Tarasoff. I'm a financial planner at PWL Capital, and I'm joining you. I know this is a lunchtime webinar, but it's 10 o'clock my time because I'm in the sunny, lovely, but chilly Calgary, Alberta. Also on this call today, we have a few faceless but talented colleagues in the chat. So as we're going through this presentation, if you post a question in the chat, it is likely that you will get a response from somebody who's from PWL. They're not an imposter. You can see Brady giving us a little wave there. Brady will be helping out with additional content, links to things that support what we're chatting about. And if you ask a detailed question that Phil and I don't get to, then he's happy to help out there. And as I mentioned, I'm joined by Philip Briggs.
Hey, everybody. Nice to meet you all. Yeah, I'm Phil. I'm a financial planner and investment advisor with PWL. If we could go to the next slide. One of the ways, as Jordan mentioned, that we want to try and make this presentation fun and interactive is by using a software called Mentimeter. And what this is going to do is give opportunity for you, the audience, to interact and participate along with us. We're going to put some questions up on the screen where you'll be able to vote or rank different things, just a way to keep you engaged throughout the presentation. And so if you'd like to log on to the software and participate in that way, there's 2 ways that you can get in. You can either scan the QR code that you see on the screen there, or you can go to www.menti.com and enter the code that you see on the screen there. So we'll give you maybe 10 or 20 seconds to get logged in. And we're going to run a test question here in a second just to make sure that you're able to participate and that everything is working.
Yeah, like you said, if you're watching on your phone, might be a little tough to jump back and forth between the question and answers and the presentation. But if you have questions that pop up, want to interact, feel free to throw it in the chat as well.
Yeah, absolutely. All right, let's try out this test question and see if people were able to log on. So just as a sample to use the software here, who currently does your taxes for you? Do you do them yourself? Do you have a family member or friend who does them? Do you work with an accountant or other? I'm not totally sure what other would be, like one of your pets or something. I don't know, but let's see if anybody enters other. Tell us what the other category is.
Yeah, I put it in there just in case I missed something, but I think, yeah, other doesn't file.
Doesn't file?
Perfect.
Yeah, okay. Maybe that, yeah.
Let's hope for the best.
Fair enough, Brady. Okay, great. So looks like we've got a good number of answers coming in. And interesting, we've got a mix across the board. Looks like the majority are self-directed in this case, but we've also got some that work with accountants as well. So that's excellent. Okay, it looks like it's working. So let's move on.
All right. And if you missed that first one, we'll put the instructions to join at the top of all future questions as well. Okay, a brief overview of what we're going to chat about today. We're going to start off with some tips and common questions that we get from clients this time of year. So hopefully the answers we give to everybody will also be helpful for you. Then we're going to dive into some pre-submitted questions that people submitted before the presentation. And at the end, we're going to have time for open questions and answers. So feel free to post your questions throughout the presentation, or if you want Phil and I to discuss something, feel free to save it for the end. We're hoping to leave some time for some back and forth with attendees. Before we dive into the content, I just wanted to say, let's try to make this time together valuable. If you have a question that's burning, someone else probably has the same one. We have a pretty good sized group here. So please ask it. If I don't explain something well, if we miss something, please add it to the questions or the chat, and we're happy to answer. Also, if you feel like taxes are a little bit outside your comfort zone, taxes are the kind of thing where if you pick up one tip, it could be worth hundreds of dollars each year moving forward. So we're spending this next 45 minutes, an hour together. Personally, I feel like a couple $100 a year each year that you file taxes is a pretty good return on investment. So let's focus today, dive into the content, ask great questions, and try to take something from today to make the most of your returns each year that you file. Because unfortunately, this is something we have to do every single year for the rest of our lives. Diving into the first topic. The first thing we want to touch on is the home buyer's plan. Not to be confused with the home buyer's plan, its recent cousin, the first time home savings account, FHSA. That's something that just came out this year and will actually be the subject of our next presentation. So stay tuned for that. But the home buyer's plan, what it is a program where Canadians can borrow against funds in their RRSP to purchase their first home. When they do that, they're taking out the funds, but not paying any tax. The reason why I specify borrow and not withdraw is because it does have to be paid back eventually. So if we look at a timeline, what will happen is you're buying a qualifying home, your first home. Can't be a rental property, can't be a second house after you bought your first. Well, you still own your first. In the year that you buy the house, you don't have to make any repayments. They're going to give you a little bit of flexibility. The year following the year that you make the withdrawal, you get a grace year. Again, no required repayments. But following that, you do actually need to start paying back that home buyer's plan into the RSP. Otherwise, what's going to happen is they're going to add back the money that you took to your income for the year. And when they add it back, it gets added to your income and you need to pay tax on it. So it's in your best interest to try to refill the RSP to pay it back in order to avoid paying tax each year on your withdrawals. So the payments start in the subsequent year. So I see a question in the chat. Can you use the home buyer's plan to fund home renovations? You qualify for the home buyer's plan. You qualify to take money out of the account if you're purchasing your first home. They don't make sure that the money goes towards the purchase of a first home. It adds to your cash to the year. So if you have enough cash to buy the property by yourself the first year, but you want to take out some money for furniture, upgrades, moving expenses, that kind of thing, you are able to use the funds for that. I mentioned you don't have to make any repayments the first year or the second year, but you do have to start paying back in the third year, I guess the second year following the withdrawal. How many years after that grace year do you have to repay the home buyer's plan? This is a question for the group. So choose a little number on the slider and then hit submit, and we can see what the group thinks. See it jumping around a bit, but we see a cluster about a third of the way up. There's no x-axis, but I'll do my best to guess. And we have about 30 responses, which is close to the amount that we received for the first question. So the correct answer is 15 years. So once your repayments start, you have 15 years to pay the money back. For easy math, just so I can do the calculations, let's say you took $15,000 out of your RSP, you borrow those funds to buy your first home. Each year, you'd be required to pay back $1,000 per year in order to make the minimum repayment. It's important to note this is in addition to your normal RSP room. So you have to put back $1,000 per year. If you don't, it's going to get added to your income for the year and you pay tax at your marginal tax rate. So Phil and I have lots of experience with this. Very often we'll look for clients and we'll say, okay, this is your RSP room for the year. This is your home buyer's plan, minimum repayment. Let's make these repayments on your behalf. Let's pull money from different accounts, get it in the accounts. And clients will say that, okay, great. So the money's in the account. I don't need to worry about it. And we say, not so fast. We can put the money into the RSP for you, or if you make an RSP contribution yourself, you're not 100% done. You need to make sure that you are specifying on your tax return that you made a repayment to the home buyer's plan and differentiated that from the RSP contribution. So if you go and you just say, okay, I got $5,000, my minimum payment's 1,000, I'm going to put 5,000 into the RSP and don't do anything else, it's going to act like that full contribution was just an RSP contribution and you ignored the home buyer's plan. When you do that, you're using up your RSP room and not making repayments, and that can cause some problems. You need to make sure that when you're filing your return, a lot of software will do a great job of this. It will say, are you making a home buyer's plan repayment? You need to say yes, or you need to take some portion of that and put it on line 24,600 of your return. A lot of people miss this, and it's not immediately obvious that they do.
Yeah, and I've seen this actually where, as you just said, I want to emphasize that it's not immediately obvious that you made a mistake, because the extra income that you've now earned from not repaying your home buyer's plan is partially going to be offset by the fact that you claimed it as an RRSP contribution. So you might not notice that all of a sudden you have this extra tax that you have to pay on your return. But in some ways, it's almost like, I like the way that you put it here, that you're almost like wasting your RRSP room by not filling both of those buckets. So to be clear, to go back to your example, if you have, say, $10,000 in RRSP contribution room and a $1,000 home buyer's payment requirement, you can put $11,000 into your RRSP. You actually get both of those buckets.
Perfect. All right. I see Brady answered some questions in the chat about this as well. But yeah, in summary, just make sure that if you're repaying the plan, that you also specify on your return that you made that repayment. Otherwise, you're not going to know you made the mistake, but it's going to waste some of your RSP room.
Yeah, perfect. Well, nice job. Okay, to introduce our next topic, I have another question here for the group, which is, would you rather receive a $3,000 tax refund today or a $3,300 tax refund 1 year from now? So give a second for everyone to submit their answers.
I noticed we have some late people who joined as well. So if you want to participate, if you want to interact with these slides, you can see the instructions at the top of the screen. Open another browser window or go on your phone, go to menti.com and put in the code 7800-1452. That will let you participate in the slides, give us feedback, and see your score reflected up on the screen as we go. So we'll give another 1 minute or so here, just in case people wanted to sign on and answer the question.
This is interesting too. This is we've got a bit of a divided group here. This is a fairly even response in both on both sides. Okay, so I like this. I like that we're split fairly evenly in both of these categories. So the purpose of this question is to illustrate that when you are filing your taxes, particularly as it relates to making RRSP contributions and claiming the deduction for those contributions, there are certain situations where you can be strategic about how and when you claim that deduction in order to try to maximize the amount of tax that you save. And so for those of you that chose receiving a $3,000 refund today, in order for these two situations to be equivalent, you would need to take that $3,000, invest it, and get a 10% rate of return in 1 year or better. If you did better, you would be better off, but you'd need at least a 10% rate of return in order to match receiving $3,300 a year from now. And so if we could jump to the next slide. Typically, the purpose of that question was to make a distinction between an RRSP contribution versus actually claiming the deduction for those contributions. I think in most situations, most of the time, we might make a $10,000 contribution to our RRSP in a year and claim the full deduction every single year. but I wanted to take the opportunity to highlight a couple of situations where you might be able to be strategic, not necessarily claim the full deduction for your RRSP contributions in the year that they are made, and end up saving yourself more tax overall. So example number one is, if you know that you have a year coming up in the future where your income is going to be abnormally high, maybe you're getting, you know that you're going to be getting paid a bonus at work, or you got paid some shares from your company that have a certain vesting schedule and are going to vest in the future, or like Jordan, I'm sure you've seen lots of these. I worked recently with a client who sold a rental property that he had owned for 30 years and had a significant amount of appreciation over that time. So he had a large capital gain, which resulted in his income being very, very high for one particular year. And so in a situation like that, where you know you're going to have a large income year, it probably makes sense, even if you're making regular contributions into your RRSP, to save some of the deduction for that large income year. So let me give you an example of how the math might shake out on this. Let's say we have someone that earns $92,000 in 2022, and they make a $5,000 contribution to their RRSP. And they know in 2023 that they're going to receive $20,000 more in income. Let's pretend they're getting a bonus. It would actually make sense in this situation for them to not claim the deduction in 2022 and claim it the following year instead. You can jump to the next slide. By claiming the deduction in 2022, they're going to get a deduction off of their income at their marginal tax rate, which in Ontario, I'm using the combined federal and Ontario tax rates here. It's going to save them 31.48% in tax, or just over $1,500. Whereas if they save it for the following year when their income is higher, they're going to get a deduction at the 43.41% marginal tax rate, which will save them $2,170. So just by deferring 1 year, you could save yourself almost 40% more in tax, which is pretty attractive, eh, Jordan? Like a way to get a guaranteed savings like that.
Tax-free, if you know for sure that the amount is going to go higher. It's a tax-free guaranteed return of close to 40%. I don't have an investment that does that consistently. And so for most clients in this situation, for most people I talk to, if they know for sure it's going to jump up the next year, it might make a lot of sense to wait. And to answer Dwayne's question, you can defer multiple years. So you can carry it forward for a while.
Well, actually, Dwayne, that's like a perfect segue into my next example. So this would be, again, a situation, you know that you're going to have an abnormally high income year. Consider deferring your deductions until that year. The second example is, let's pretend that your income is, the same on average, but for whatever reason, you make an abnormally high RRSP contribution in a single year. So the example that I had recently, I was working with a client, and unfortunately his mother passed away and he received an inheritance from her. And so we used some of that money from the inheritance to make a large RRSP contribution in a single year to catch up on unused room that he had accumulated and carried forward over time. And so again, just for easy math, he makes about $90,000 per year. We made a $90,000 RRSP contribution. And so in theory, if he wanted to, he could have claimed that entire deduction all in 1 year and made his income zero for the year, which I don't know about you, Jordan. To me, that kind of sounds cool. Like that you had zero income for the year, you paid no tax as a result of making an RSP contribution. But it's actually a bit inefficient to do it that way, because not only are you getting a deduction at your highest marginal tax rate, you're also getting a deduction on the income where you were charged lower tax rates. And so by claiming it all in 1 year on the $90,000, it would save about $22,000 in taxes. Instead of claiming it all in 1 year, what I suggested is that we claim the deduction over multiple years. So to Dwayne's exact question, just as an example, if we spread it out over 3 years, so we did 40,000 in year 1, 40,000 in year 2, and 10,000 in year 3, Just by implementing this strategy, it would save approximately $27,000 in taxes instead. And so again, this is an example of a strategy that you could look to implement where even though you've made a contribution, you spread the deduction out over multiple years to benefit from getting the deduction at a higher tax rate more often. And just to hammer this point home, if we could jump to the next slide. The reason that this works is because in Canada, we're under what's called a progressive tax system, which is the idea that as you earn more and more income, you pay a higher percentage in tax on the next dollars earned. So to give an example to maybe explain that clearly, if you make, say, $100,000 in a year, the last $10,000 that you earned, or the most recent $10,000 that you earned towards the end of the year, is actually taxed at a higher rate than, say, the first $10,000 that you earn at the beginning of the year. And so the idea is to try to get those RRSP deductions where it's saving you the tax that you pay on that last $10,000 that's being taxed at a higher rate. It doesn't make as much sense. I mean, if we look, these are again the tax brackets combined, federal and Ontario. You can see, for example, that if you earn, say, $15,000 in a year, you don't actually pay any tax on that money. So in my example, getting your income all the way down to zero for the year doesn't make a lot of sense, because at a lower level of income, the tax rates are much lower, and so the deduction isn't quite as beneficial.
Yeah, if you have no income, you might want to create income to use up that lower tax bracket rather than create a deduction by using RSPs. So that comes into the planning side of it, where we'll end up talking people out of using RSPs for a year because their income is unusually low. And then I put a link at the bottom of this to Ernst & Young's calculator page. They do a great job of combining the provincial and federal tax brackets by year and including any credits that you get in each province as well. If you look at just the province's tax brackets at a high level, it doesn't factor in all these little credits and things. So typically when I'm doing this analysis, I use the Ernst & Young page that I've linked at the bottom there. Mentimeter software is interactive, so you can click that, open it in a new tab for later, and then come right back to interact with the slides. Next question for the group. We're going to determine which of these statements is true and which of these is a lie. We're branching away from the registered retirement savings plan towards taxable investments now. So accounts that are held outside of a registered plan like a TFSA and RRSP, because with these investments, they're not tax sheltered. We need to make sure that we're tracking the dividends, the interest, the gains that happen inside these accounts, so that when we file our taxes, we're accurately including them on our return. So I'll give everyone a few minutes to fill it out here. Things that people are putting in blue are what we believe is correct. Things that are in green are things that we believe are a lie. Once we have about 30 responses from the group, we will go and give you the correct answer, so you're not left in the dark. We can see it's not clear across the board. There is a bit of a split on each question. All right, I'll give it another minute here. We had about 30 responses for the last one. I'd like to have about 30 for this as well. It'd be great if someone else joined in using the link at the top there to answer, but we'll hold tight until we hit about 30. You can see an equal split on the first one. The cost base of an investment is the weighted average of the buys and sells of that investment. The gains, losses in US assets must be claimed in Canadian dollars. And the last one is your brokerage account statement going to be accurate for you to work off of? All right. Well, we will jump into it now. I just realized there might be a bit of a misphrasing on the first one. It might just need to be just the weighted average of the buys, but we'll dive into that in a second. And we can see that the first one is true. Your cost base ends up being a weighted average of the buys. The second one is also true. If you're trading US securities and US listed dollars, it still must be claimed in Canadian dollars. We'll touch on that a bit. And then the last statement is false. You cannot trust your brokerage statements blindly. They do their best to keep track of these things for you, but they can't see all your accounts. They can't see all your trades all the time. Sometimes they make mistakes. And so very often we recommend tracking this yourself or engaging with a tax professional to make sure that you're not making mistakes. One of the problems with mistakes is that typically you will not mispay taxes, and they're more than happy to charge you interest on missed tax payments. All right, let's dive into taxable accounts. So let's focus on just Canada for now. And this is a great question to illustrate how we calculate the cost base on an investment. So let's say that we're buying shares of ABC company, a made up stock, in a taxable account outside of a TFSA, outside of an RRSP. We bought 5 shares at $1. All of a sudden the share price shot up to $3. And then so you bought in twice, five shares at $1, 5 shares at $3. What would be the cost base when you sell the next share, the next one share? Looks like everyone's clustering around $2 at the moment. And so you've spent $20 total to purchase 10 shares in this situation. And we're assuming it's all in Canadian dollars. We're ignoring the US side of it for now.
Oh, some people are voting for something else too. They think this might be a trick question.
Exactly. All right. I'll dive into it then. The correct answer on this question is $2. So in Canada, we calculate the pooled cost base. So in this case, we spent $20 total to purchase 10 total shares. 20 divided by 10 is $2 per share. So if we were to sell a share, then we would have a $1 gain if we sold it at $3. The reason why a lot of people get mixed up is because in the United States, there's something called tax lots. So with tax lots, you're actually able to choose which shares you're selling, even though they're all interchangeable, really. Like you don't really care whether you have one share of a company versus the other same exact share of the company. But in the US, you can say, I'm choosing to sell shares that have a very high cost base. And because I'm choosing to sell those shares, my gain is going to be less on those ones. In Canada, we don't get that luxury. We have to pool and calculate our cost base. And what can get really tricky actually is you can open multiple brokerage accounts and buy the same stock in different accounts, and they don't know that they're not talking to each other, right? So let's say I did the same thing. I bought 5 shares at $1 through my employer plan. And then I bought 5 shares at $1 through my own personal Questrade account. Those accounts don't talk to each other. So they have no idea what the pool cost base is across both. They're going to do their best to track and see what my capital gains will be, but they don't know I own it somewhere else. So they're not talking to each other. Another great example is, let's say I have RSUs vesting at work. So I bought some company stock. And then as part of my employment program, I also get company shares given to me on a regular basis. Those count as buys. And those are going to change my adjusted cost basis, but they're not going to talk to each other. So what we recommend is every time you come into possession of the same security, you go and you calculate and you update your cost base, because all the time we'll see it. Phil, I'm sure you can corroborate this, is that people choose to wait until after they sell their shares and then go back through all the statements, all the transactions, and try to figure out how much tax they're supposed to pay.
Yeah, and the exact situation that you just mentioned is where I've seen this in the past. I saw some questions pop back up in the chat about like, well, why would the forms be wrong? And it's exactly that. It's because, you know, if you've got Questrade and Wealthsimple, the same stock in each, Questrade is going to send you your T5008 form with the cost base based on what you bought there, but they may not realize that you own that same stock at another brokerage at a totally different cost base. And in reality, you do have to average the two. And so that's why, you know, those forms potentially, as you said, you may not want to trust exactly what's on there. You've got to do some manual calculation yourself.
And I see a great point in the chat about superficial losses. We chose to leave that out today because that's a whole can of worms there. But yes, if you're buying and selling the same thing quite often, you can end up canceling out losses, which Phil's going to dive into in a second here. But this highlights something that's quite important when we start working with somebody. oftentimes what we'll do is have to go back through all their old statements, all their transaction reports, and make sure that the numbers we're working off of for their accounts are accurate based on all the different times they bought and sold. Another question in the chat. I wouldn't assume it's accurate. I would double check it just to be safe, just to avoid any sort of extra tax penalties on this. And it gets even more complicated, actually, if we start trading securities, ETFs, things south of the border. So this ties into the second question that we asked. When you're trading US stocks listed in US dollars, all of the purchases and the sale need to be converted back to Canadian dollars. The tricky thing is that all your buys need to be converted back to Canadian dollars on the day that you bought. So if you're regularly putting money into a S&P 500 ETF listed in US dollars, because they're quite inexpensive, if you're regularly doing that and buying in, you need to know the conversion rate on the day that you bought in for each trade and what you paid in US dollars. This is all for non-registered, of course. Yes, don't worry about this in just RSPs and TFSAs. Because in those accounts, when you have dividends, interest, you do trades, it's all sheltered inside that account. And that's one of the reasons why you don't want to waste that room. We talked about the home buyers plan, not wasting your RSP room. It's a precious tax shelter. You want to make sure that you're not wasting that by not repaying the home buyers plan. So with US securities, you need to track not only what you paid on each day, but also the Canadian conversion rate on that day. And then you're going to pool it all together in Canadian dollars. That's your Canadian cost base. When you sell, you need to take the conversion rate on that day. So everything needs to be converted back to Canadian dollars. And this can create a kind of funny situation where if the stock in the States did really well, but the US currency actually did really poorly, you can have a gain in the US, but a loss because of the currency, which is super counterintuitive, but also highlights the risk of investing in different currencies and keeping track of all of this. So we linked to the Bank of Canada website here. This is the resource we like to use to look up historical exchange rates. But keep in mind that if you made money on a US security, it doesn't necessarily mean that you made money in Canada. The opposite can happen as well. You can own a US security that drops in value, but because the US currency does really well, you actually made money and have to report a gain in Canada. So you need to be careful with figuring out the losses and the gains in Canadian currency, not in US.
Right, perfect. And actually, just one other quick point on that too. This is where, again, I think we talked about this previously, but when you are making purchases in your taxable investment account, it's probably a good idea to try and keep track of your adjusted cost base as you go. Like when you make the purchase, note the security price that day, note the foreign exchange rate that day. If it's a US dollar or foreign company, don't get into the situation where you sell a bunch of stocks and you then have to go back through years of transaction history and looking up past rates to try and figure it out. It can be pretty stressful, I think, and a lot of work. It's probably a best practice just to keep track of your adjusted cost base as you go.
A lot of people I work with or talk to will change brokers too.
Yeah,
so they'll
right.
transfer securities in kind from one broker to another and not have that cost base transfer over. So you go back and you have to try to get statements from accounts that have been closed. So it's good to track it and keep track of it on your own books as well.
Yeah, absolutely. Okay, nice job. Okay, so for our next topic, again, just as a question here to sort of introduce the subject, can you use losses in your TFSA to offset gains elsewhere? I'll give another 10 seconds or so for anybody else that wants to put their answer in. And so the correct answer to this question is no, you cannot. And Jordan mentioned it earlier. This applies both actually to the TFSA, but also the RRSP, the RESP, any registered accounts where you have losses because you're receiving that tax sheltering inside of those accounts. You're not paying taxes on the realized gains, so you're not able to use the realized losses to offset gains elsewhere. And so the whole idea behind this question was to introduce the concept of realizing capital losses. And so let me explain a little bit more about how that works. If you've opened your own taxable self-directed investment account where you're going to pick stocks, which I don't know about you, Jordan, like this became quite popular. I feel like over the pandemic, we heard lots about, Robinhood in the US and that sort of thing. Lots of people fancied themselves stock traders during that time. And I think the reality for most of us is that when we're picking stocks, of course, we're hoping that we're going to make gains. We're hoping that we're going to pick winners. But there's a lot of research and a lot of data that show that picking stocks and being successful with that over the long term can be very, very difficult. And certainly if you pick a number of stocks in your portfolio, they're probably not all going to go up in value. I think it's probably highly likely that you're at least going to have some that are going to go down a little bit. And so that's not a fun situation anytime it happens, but you can kind of turn lemons into lemonade by selling those stocks at a loss. And when you do that, you are realizing a capital loss, which can actually be used to save you some money on taxes and offset gains that you've either made in the past or gains that you will make in the future. And so just to give you an example, let's say you sell some stocks and realize a loss in 2022. You have two options for how you can use those losses to save yourself some tax. You can go back to any of the last 3 calendar years. And if you had realized gains in those years where you paid tax on those gains, you can actually refile your tax return from one of those years and use the loss from this year to offset the gain that you had in the past. So in 2022, you sell, you realize a loss, you can go as far back as 2019 to use that loss against gains from those years to get some of that tax money that you paid back. Now, if it's a situation where you don't have capital gains from any of the past 3 years that you want to offset with your losses from this year, that's okay. You can actually carry the capital loss from this year forward into the future indefinitely. So just as an example, like let's say you sell and you have $5,000 of losses this year that you realize. Well, you know that going forward in the future, your first $5,000 of gains inside of your taxable account are going to be tax-free because you're going to be able to use the loss from this year to offset it. Now, we've mentioned it a couple of times, and just to be 100% clear on this, this applies only to your taxable account. And that's why, Jordan, if you give me a minute here, I'm going to get up on my soapbox and make a little bit of a public service announcement. This is why we would strongly advise that you don't trade individual stocks inside of your registered accounts, inside of your TFSA or your RRSP. In those accounts, you want to have a broadly diversified portfolio that's going to have the highest probability of success over the long term. If you want to have kind of like a side account where it's maybe a bit of play money, you want to trade some stocks and learn from that experience, that's fine. But make sure that you do it in your taxable account, because again, like we all want to think that we're the next Warren Buffett and that we're going to be super successful trading on the market. But if it so happens that you do have some stocks that you pick where it doesn't work out, use that to your advantage. Give yourself the ability to realize those capital losses to save yourself some tax. If you do this inside of your TFSA and the value of the stocks decline in value, not only do you not get to realize the capital loss, but you've also kind of wasted that TFSA room. And so instead, you'd be better off to do this inside of your taxable account. Rant over, I'm going to get off of the soapbox, but that's one thing that I definitely feel strongly about and wanted to ensure that we made clear.
And we explain that to people all the time because no one buys a stock expecting it to go down. Everyone says this is the best thing. This is going to shoot to the moon. I want it to all be tax-free. Let's load up the TFSA. And very often we need to temper expectations a little bit, talk about the downside just in case it actually does occur. And one point of clarification on this, the losses need to be triggered in the calendar year of 2022. Mm-hmm. So very often you'll hear people in December talk about tax loss harvesting. What they're doing is they're going through all their positions, finding some losses at the end of December, intentionally realizing those losses with the intent of using them to offset past gains or future gains moving forward. That is a bit more of a complicated strategy. You need to make sure you avoid any superficial loss rules like were mentioned in the chat. But if you hear someone talking about tax loss harvesting, this is what they're talking about: intentionally realizing losses in order to derive a tax benefit from those losses. All right, now we're going to jump into some of the pre-submitted questions. But just before we dive into that, there's a few ways for you to stay in touch with our team. So like I said before, all these links are clickable. You can open them in new tabs. I've included a link to speak with a member of our team. So if you say, wow, taxes are tough. I work with an accountant, but I want someone to do proactive planning like this for me. You can reach out through our contact page, talk to a member of the team. It might be Phil, might be me, might be one of my colleagues. And we're happy to just point you in the right direction, give you some insight on what the best course of action is for you in order to get the help that you need. Like I said before, we put out lots of content on a regular basis to try to help Canadians with their money. If you want to find out about next presentations, videos, podcasts, that sort of thing, you can sign up for our newsletter. And then we have white papers, blogs, all kinds of great content on our website, pwlcapital.com. And just to be clear, we're based in Ottawa, but we work with people across the country, Victoria to St. John's, across the whole place. And like I said, I'm in Calgary, Phil's in Ontario. We have people all over the place. All right, let's dive into some of the pre-submitted questions. So the first one we have is from, Phil, do you have it up?
Yeah, I do here.
Okay.
I have it. It's from Brian. And Brian, thanks so much for submitting the question. The question is, I recently inherited a rental property. What do I need to know for tax purposes for both the rental income and for receiving the property? So Jordan, do you want to talk about the second part, the actual receiving the property? And maybe I'll chat about some of the tax considerations for the rental income.
Yeah, for sure. So I'll talk about what happens, I guess, on the inheriting the property side. So when someone passes away in Canada, the CRA acts like right before they passed away, they sold all their stuff for tax purposes. So with rental properties, especially in Canada, what that can mean is that you're triggering very large gains. So let's imagine this property is in Vancouver. They bought it for 200 grand and now it's probably worth 30 million. Well, realistically, it's probably worth it's probably worth like 2 million though. Vancouver is taking off like crazy. And so if they bought it for 200 and right now it's worth 2 million, that means there's an embedded gain in the property of $1.8 million. If the person who passes away wants the property to go to their kids, it's as if they sold it and then it went to the kids, but they actually don't get any cash because they're not actually selling it. So there's a $1.8 million gain, which is going to go on the final return of the person who passed away, but there might not be any cash to pay the big tax bill on that because a $1.8 million gain, half that gets added to your income, so 900,000, it could create a $450,000 tax bill. And if you don't have $450,000 kicking around in cash, it might be really hard to pay that to make sure that the estate is all settled up. So what this can result in is a situation where you have a large tax bill and no cash. And so you could either be forced to sell the property when you don't want to, you want to keep it in the family, or you have to try to get together cash personally elsewhere in order to do it, in order to keep the property. So typically we advise clients that if there's property with large embedded gains that you want to go to beneficiaries, you want to discuss it early. You want to figure out a way to have money set aside to cover that tax liability sooner rather than later, because you want to be able to sell the property on your terms, not in a rush.
Yep, that's exactly right. Yeah, the tax planning part of the estate plan, super important to take a look at. And so assuming that, in Brian's case, the tax is all paid and now Brian owns the property moving forward and is going to continue to keep it as a rental. Well, congratulations, Brian. You're now almost like a business owner. You're a landlord. You've got this other source of income coming in. And so there are definitely going to be some tax considerations that you're going to need to keep in mind. Number one, obviously, you're going to have this rental income coming in on a regular basis. This is going to be extra income for you that you're going to need to claim on your return every single year. You're also going to have expenses that are now related to this property. And this is where I would highly suggest, if you are going to be a landlord, it's probably going to be helpful to work with a tax professional, because there are some intricacies that go into keeping track of your expenditures. Just to give you an example, there's a distinction between current expenses versus capital expenditures when it comes to a rental property. Current expenses are things like normal, maintenance, that, putting paint on the walls, or if something breaks, having to replace it, or just anything that doesn't necessarily improve the value of the property, just sort of the normal costs that go into owning a property. Those are things that you're going to be able to write off on your taxes on a regular basis. Capital expenses are anything, more significant renovations that'll go into the property to actually improve its value. There's different tax consequences for those. You can't write those off. They actually increase the adjusted cost base on the property. So they do help you with your taxes by reducing the gain when it's eventually sold. But it's going to be important to keep track of all of your numbers, to keep track of both of these things, and potentially get an interpretation from an accountant around, is this expense that I had, is it a current expense? Is it a capital expense? So these are some of the things that come to mind for me that you're going to need to think about as a rental property owner.
Yeah, it's tough to tell, like, if you replace carpet with slightly better carpet, do you get to write that off, or do you get to claim that as capital expense? I think I'm guessing if you replace carpet with heated hardwood floors, you probably have to capitalize that one. But again, there's so many little nuances throughout all this. It's good to consult with a tax professional who does this on a regular basis. Don't just try to guess yourself. And I saw a question from Rodrigo. We're referring to rental properties here. If the person who passes away is declaring the property as their principal residence, that's tax exempt. If it's a cottage or like a second vacation property, it gets pretty complicated because you're only allowed to have one principal residence at a time. So you'd want to coordinate with a tax professional to say which property are we going to declare as a principal residence and which one are we going to pay tax on in order to minimize the taxes overall to the estate. Phil, do you have the second question?
Yeah, I do. So this one was submitted anonymously. And it's interesting because I think the last time, Jordan, that we did a tax presentation together, we got almost this exact same question. So I know you had an opportunity to do a bit of research on this. The question is, how can I do my crypto taxes easily if I did a lot of swaps between coins, as well as used the earn feature in Binance to get interest? Is there an easier way, like only using my net gains and losses?
So you're right that I did some research into this, and I'm also going to deflect in the exact same way that I did last time, is that crypto is complicated. There is a guide on CRA. I believe it's called Cryptocurrency Guide for Tax Professionals and Individuals, I think is what it's called. And it dives into the sort of the new interpretations because it is a new technology. There's not hard and fast rules written in clear black ink completely yet for CRA. But when I was doing my research, I found a few interesting things. One is that when you switch between a coin, that's viewed as a deemed disposition. So when you switch between coins, again, I'm speculating that all these coins are very, very different a little bit. But when you switch, it's the same as if you sold, got cash, and then bought the new coin. So each of those would be a taxable event from the research that I did. Also, which is also kind of scary, this is a big one, is it's not clear whether trading crypto is an investment activity or a business activity. And the reason why that's important is because if it's an investment activity, you get taxed at capital gains rates, which are half what business rates would be. So if you're regularly trading crypto and making money doing it, it's really important to talk to a tax professional to see if you're running a business or if you're doing speculative investing in the space. And so I don't have the expertise to make that call. And a lot of accountants are trying to ramp up on that, but it can be a huge difference in the tax. It can double the tax that you pay on your trades if you're doing it as a business. And it's going to be hard to catch that until later. And like I said before, they start compounding penalties on missed taxes from the day you made the mistake, not from the day that you find the mistake. So it's really important to make sure that you stay abreast of those rules.
Yeah, this is one of those ones where paying a tax professional is definitely worth the investment just to avoid a mistake in this area, because it could end up being costly, no doubt.
Perfect. All right. Those are the pre-submitted questions that we had, but we're going to stick around for another few minutes here. We have 9 more minutes till the end of the hour. So if you want to put questions in there's a Q&A interface, there's a chat. Phil and I are happy to stick around and answer questions from the group. There's our lovely disclosures that we have to show as a financial services firm. And yeah, we'll stick around for a little bit to see what we get.
Okay, here's a question in the chat. For investments inside a corporation, the passive tax rate is higher than tax on active income. If we borrowed to invest in a corporation, to which rate does the loan interest deduction apply?
Are you confident answering that off the top of your head, Phil? We might leave that one to Brady to verify the numbers, just in case.
Yeah, that's a tricky one. And that again is where, if we've said it a couple of times, but if you are implementing a more complex strategy like that, where you are borrowing to invest and there's a few different variables, this is where working with an accountant is going to be really, really important. And so that is definitely a big takeaway, I would say, from this presentation.
Yeah, we're not accountants. We're not going to dive into that one too deep. And same to answer Michael's question, it's going to be expensive to find someone specialized in that space. It's going to be a niche service. So because they're going to have very few clients, they're going to have to charge a very high fee to make a living. And so that's typical from what I've seen. It's quite high. I don't know where you're going to find a reasonably priced specialist in the crypto space, unfortunately. So yeah, it's tough.
Yeah, they're probably going to have to do like research on your behalf just to, figure out the rules and try and interpret them for you.
Yeah. And you have to submit, oftentimes accounts for new technologies like this, will have to submit for interpretations from the CRA,
Right.
which can be expensive and take a long time. But yeah, Kenny Shaft, well, hopefully you're making money in this space at least. Because if it's gains, then you want to get it figured out. Because if you make gains and then owe taxes, you'll have a penalty. But if you're losing money in crypto and you have losses, they don't charge you penalties on losing money, which is some consolation, I guess.
Okay, any additional questions while we have a couple of minutes left? Feel free to throw it into the chat, or if there was anything that needs clarification from the presentation.
All right. And we're going to send out a follow-up to the group who attended. Feel free to give us feedback on what you want the next webinar to be about. We made this one about taxes because it's tax season. But we're planning on talking about the first home savings account, some stuff on retirement planning, expenses versus how much money you need to save. I saw a BMO article saying that people need $1.6 million to retire. Is that actually true? So please give us feedback on what you want to hear about next. Follow us on social media. We'll be posting links to the next webinar. And I see a question from about RSUs. Do I get taxed on RSUs when they vest or when I sell them? So that's a good question. The answer is both. So when RSUs vest, so at a high level, when you get granted RSUs, what a company is doing is taking some shares, putting them aside and saying, when those RSUs vest, we're going to pay you a bonus equal to the value of those shares. That's incentivizing you to work hard, make the company's shares go up so that you get a bigger bonus. When those shares vest, the market value of them gets added to your income at your income rate. If you take the RSUs as shares, it's as if you bought the shares that day and that's your new cost base. So let's say they were granted at $1, they vested at $2. Now you have shares with a cost base of $2. You already paid income tax on it. So you only pay tax on any future gains above that. So let's say that now the shares go and they go to $1 and you sell them. Now you have a $1 loss, capital loss. That can't be used to offset the income because income and capital losses are different. Mm-hmm. Say you take that $2 share and it goes up to $3. Now you sell it. You're only going to pay tax on the difference between what it vested at and what you sell it for. So when the RSUs vest, you pay tax on the bonus no matter what. And it's as if you bought the shares and you start over from scratch. You get to say, if it goes up, I pay tax. If it goes down, I don't. But the unfortunate answer is you get to pay tax twice if you make money twice. Perfect. The meetup today is in Montreal. I think we're trying to do some in the States as well. I think that,
I heard
we talked about
LA potentially. Yeah.
yeah, LA, but I don't think anyone in this will be LA because we don't, we're trying to distribute, we don't work with US clients.
Yeah.
Can't find event page on social media. Any tips? I don't know about this. Angelica, are you around? Can you answer this one? Oh, there she is.
There you go. She put it in the chat. Can
Yeah.
email
We have our head of marketing there.
rationalminded.ca. Yeah.
Okay,
Okay.
awesome. I don't see any other questions. Phil, you think we're good to wrap this one up?
I think we're good to wrap up. Thank you so much, everybody, for coming, for participating. As we said, there are going to be more of these happening in the future. And so please come back. We're going to try and do a variety of different topics, and we hope you found this valuable. So thank you for coming, and everybody enjoy the rest of your day.
Bye, everyone.